Welcome to Striking Options, the show that reveals the options you have to better navigate markets. I'm Jeff Kilgren. I'm joined today by Scott Bauer. Hey there, Scott.
Jeff, how you doing?
I'm doing great. Interesting week upon us. 150 names roughly reported in the S&P 500 during this heart of the earnings season, but we also have a big Fed meeting. What is the Fed going to tell us?
Yeah, big Fed meeting, lots of economic data, and the 94% chance right now that the CME FedWatch tool predicts a cut coming up here. And really what the market is going to be watching, though, is what are they going to say moving forward? How dovish or hawkish are they going to be?
No, that's a great point. This will be the third rate cut. Quite the contrast from last December when we anticipated 3 rate hikes. But nonetheless, that Fed messaging, what are they going to tell us? Because there's so many moving parts with all the central bankers across the globe. Will they be more dovish? It seems like that's been the track so far.
Absolutely. And again, with some of the economic numbers coming out after the Fed speaks, that could be just as important as what the Fed says.
Well, we will see. But let's get this first lightning round. You ready?
Yeah, let's do it.
New all-time highs. Well, sure enough, we're seeing the 1-2 punch. We're seeing earnings come out better than expected, but we're seeing the continuous accommodative stance of the Fed push equities higher. Here we are in the S&P 500 at new all-time highs. Is there any stopping of this?
I mean, everything looks pretty decent so far. Again, you said that earnings have been pretty good so far. So, the market really is potentially set up for a move higher. But, given that, I'd like to take advantage of that. And I'd like to sell a week 2 3,100, 3,150 call spread in the E-mini S&P 500 that expires next Friday, November 8th.
So this is interesting. This is a way to potentially hedge a long portfolio. So if you're long the stock market by selling a call spread, you're going to collect that premium. Of course, you're not going to participate from that 3,100 up to 3,150 level, but you're anticipating that the Fed is going to give a little bit of a message. Maybe we stay a little stagnant or even potentially pull back like we have last couple of meetings.
Right, exactly. That's what's happened the last couple meetings here. And, even if the market does rally a little bit here, a call spread like this can really help that long portfolio.
And on this call spread, you're going to collect about $94. And remember, the futures were trading around 30.43 when this trade example was priced out, and that at-the-money volatility just under 10. So significant to note that level, Scott.
Absolutely. And again, this is more of a hedge against a long portfolio going into what could be, kind of confusing Fed statement.
Great stuff, Scott. And please remember, these are trade examples, not trading recommendations. Let's move into the second lightning round.
All right.
U.S. Treasuries. Well, U.S. Treasuries continue to perplex all investors globally. We're seeing the 10-year note stay subdued under 2% for all of 2019, but it seems like a range has really been defined.
No doubt about it. We've seen that 10-year trade really about 150 to 185. We are at the upper end there, but it is very range-bound over the last 3-6 months or so.
And that upper end in the yield, right around 180, 185, really coincides with the new all-time highs in the equity market. So the trade example I want to utilize is anticipation that we remain in this range. So I want to be a buyer of the week 2 10-year note, 130, 131 call spread. This is going to cost investors about $125 and expires on November 8th. Same expiration as yours, Scott. But this is in the event we do see yields come back and prices of the futures go back up.
Absolutely. And the D's futures here were trading about 129.07, and the at-the-money vol very low at 5.18, which makes a spread like this more inexpensive than if volatility was trading higher.
And utilizing options on futures certainly gives you more tools in your toolbox when you do see new all-time highs, but another opportunity are the micro E-mini futures. So if we look at the E-mini S&P 500 futures here, we're trading around 30.43. Maybe instead of utilizing a call spread, maybe you could be a seller of some of these micro E-mini S&P 500 futures at this 30.50 level.
Absolutely. An investor could possibly look to kind of stagger those entry points there, maybe at 31.20 up to that 31.50 level that we were talking about before.
And remember that the micro E-mini S&P 500 futures are 1/10 the size of the normal E-mini futures. So a typical one lot in the E-mini futures mitigates about $150,000 portfolio from a risk exposure from a notional value. So if you only utilize 5 micro minis, you're only hedging about $75,000 if you were to be a seller at this 30.50 level.
Right. It's a very flexible way to use that.
All right. Great stuff, Scott. Thanks for coming on. And make sure you tune in every week as we will continue to strike options.